When I started my first job after graduating college, it seemed like the only way to retire was to patiently contribute to a 401k and wait until I hit 60 years old. Then I could finally live a life free from that job using my hard-earned retirement savings. This didn't really make sense to me though. Does it really to anyone? Why did I have to wait until 60 years old to live the life that I wanted? When I asked around why the retirement age was, for only 60s and up, people laughed at me and questioned why I thought I could retire earlier. When you're in your 20s and 30s, 60 years old sounds like an eternity away, and it can be hard to save for a retirement that seems so distant in the future. Trust me, I've been there. I did not want to retire at age 60. My goal was to achieve financial freedom way before 60. That's when I realized that retirement means so many different things to so many people. Since those early days of figuring out how to retire early, I've realized that, unlike what people say, it is possible to achieve financial freedom at a younger age. In today's video, we're going to be talking about the specific steps to take in order to achieve financial freedom. By the end of this video, you'll have enough information to formulate your own plan on how to achieve your financial goals, whatever they may be. Let's get started. Step 1, figure out how much money you need to achieve your financial goals. The first step to achieving financial freedom is to figure out what financial freedom means to you. Everyone's definition of financial freedom is slightly different. Maybe it means having enough savings to afford a certain lifestyle without the need to work. It can also just mean retiring as early as possible and then living frugally but freely. Whatever financial freedom means for you, this step is important to figure out because the money you need saved up will depend on your goals. For instance, let's say that you want to take the traditional path of retiring at age 65 years old and you want to live off around $60K per year for the rest of your life. The general financial rule of thumb here is that you should multiply your estimated annual retirement income by 25. This is known as the 25 times rule or the 25x rule. So in this scenario, you would need $1.5 million in order to comfortably retire. From here, there's another financial rule of thumb known as the 4% rule that says that you can withdraw 4% of your savings every year in retirement without running out of money. 4% of 1.5 million equals $60,000. Great. Really straightforward. Now, that all sounds great, but there's a catch. These rules heavily depend on when you retire and how long your retirement will last. So if you choose to take the traditional route and retire at age 65, the 25 times rule and the 4% rule will likely end up working out. But if you want to retire at the age of 40, then these rules will not apply to you because you'll need to account for around 40 to 50 years of retirement compared to the, let's say, 20 to 30 years of retirement if you retire at age 65. Now, there have been a ton of studies done to determine what the safest withdrawal rate is for a longer retirement. One study found that using a withdrawal rate of 3.5% or under is very safe, even if your time horizon is significantly greater than the traditional 30 years or so of retirement. So using this 3.5% withdrawal rate, try taking your estimated annual retirement income and multiply it by around 30 times to get your magic retirement number. So for example, if you want to retire at age 45 and plan on living off around $60K per year, then you'll need around $1.7 million in order to retire. There are plenty of retirement calculators out there that can also help you figure out how much money you need to retire, but we'll leave some links below for you to try. No matter which calculator you use, it's very clear that the earlier you plan on retiring, the more money you're going to need to last through retirement. That's straightforward. If you like this video and want to see more of our content, hit subscribe right now. We'd really appreciate it. The next step is to assess your current financial situation. Think of yourself as a business owner. Every business owner regularly sits down and calculates their income, their expenses, and their overall profits and losses in order to make sure that their business is on the right track. Probably do it daily if you're a business owner. This is known as tracking the balance sheet and cash flow statement. These two financial statements are not just used for businesses though. They can also be used for your personal use. When thinking about your personal balance sheet, this is basically your net worth calculation, which is your total assets minus total liabilities. Assets are things that you own, like the cash in your bank account, the car that you bought last year, or the investment balance in your Roth IRA and 401k. On the other hand, liabilities are all the things that you owe, like credit card debt and student loan debt. In addition to knowing your current net worth, it's important to know how much money comes into your bank account and how much money leaves your bank account every month. The difference between your incoming and outgoing cash flows can tell you a lot about your situation. Like if you made $10,000 last month, but you also spent $12K, you have a negative cash flow, which means there's probably something that needs to change. It's not sustainable. But if you have $10,000 coming in one month and just $5K going out, at a glance, it's looking pretty good. There are tons of ways to track your assets, liabilities, and cash flows, such as online financial trackers like ours at Wealthfront. But you can also just use a Google spreadsheet if you like to calculate this manually. I'd say ours is a lot easier. The point is that you need to get a clear picture of your financial health and status today. Step 3, get control of and pay off your debt. After step 1 and 2, you should now have a number in mind that you need to reach in order to retire, and also some form of tracking for both your personal balance sheet and cash flows. Looking at your balance sheet and cash flows, think of where the biggest areas of improvements are. Is it having too much debt on your balance sheet? Are you spending too much money? Are you not investing and saving enough? Or is it just not having enough income to keep up? Figure out what needs to be your main area of focus. And let's talk about the debt first. One of the most powerful tools in personal finance is compound interest. It can be both amazing when it comes to investing and saving, but it can also be dangerous. And it all depends on what it's compounding. So when it comes to debt, compound interest works against you. It doesn't work for you. When you borrow money, you accrue interest on any principal that you do not pay back. If you don't pay the interest charges within a certain period, that money can then be capitalized, which basically just means it's added to your initial balance. So that balance can just keep growing in a negative way. So if you're holding off on paying a credit card balance of, let's say, $20K at an annual interest rate of 20% compounded monthly, this would result in a total compound interest of $4,388 over 1 year, or about $365 per month on average. If you wait to pay that credit card off for about 2 years, then the total compound interest jumps to over $9,738, or around $406 per month. Every month you do not pay it off, the interest continues to compound and increase. This is the danger of compound interest when it comes to debt. Any delays in paying it off can spiral your debt out of control. The longer you wait to pay off your debt, the more interest you could end up paying. If you have different types of debt that you owe, I would start with the higher interest debts, since high interest is the most dangerous type of debt to leave around. For most of us, the most common form of high interest debt involves credit card debt, but it can also include personal loans or general debt consolidation loans. If you want to achieve financial freedom early, you need to take care of your debt as soon as possible. I'm giving this advice from my experience. At one point, my wife and I had around $80,000 in student loans and credit card debt around $20 to $30K, and we felt like we could not plan our financial future until we paid off that debt. For example, we would talk about buying our first home, right? Living in San Francisco, or increasing our contribution to our investment portfolio. But the conversation would inevitably go to, well, not until we pay off our student loans and take care of that credit card debt. When we finally paid off the debt in our late 20s, it was by far our greatest financial achievement to date, and it finally allowed us to move forward in our financial journey. Here are some methods that can help you pay off debt as fast as possible. The first is to stop using credit cards and to just use a debit card or use cash. If you struggle with impulse buying or constantly forget to pay off your credit card each month, stop using them. Using cash can help fix bad spending habits. I know for me, using real cash instead of swiping a credit card helped reduce the temptation of spontaneous purchase. Another method is to use some form of debt consolidation to simplify debt payments. Debt consolidation combines all of your debt payments into a single payment and sets a structured plan for paying off your debt. If you don't consolidate your debt, you never see that finish line and end up getting caught up in the downward spiral of debt. When I finally started the process of going through debt consolidation, just being able to see a finish line, a finish date, and a fixed payment each month gave me the motivation and discipline to chip away at my debt each month. Another strategy is to use any extra income or windfall that you receive to pay off your debt. When my wife and I received a windfall from her company's IPO, we put all of our money into paying off our debt. And looking back, it was definitely the right decision. As we talked about before, every month that your debt is not paid off means potentially even more money you have to pay. So when my wife and I were in debt, we decided that debt would be our number one priority and everything else would be on pause until that debt was gone. We did not contribute to our 401ks and other investments. We focused just on debt. Obviously, we were on the more extreme end of paying off debt, and having a windfall obviously helps. You can pay off debt concurrently with saving and investing as well, but to us, being debt-free meant everything, and we wanted to achieve that ASAP. Just do what you think is best for your situation. Step 4, find areas to reduce spending. The next step to achieving financial freedom early is to reduce your spending on non-essentials. The small purchases here and there can really add up. I recommend taking a look at all the non-essential purchases that you made over the last month and see how much you could have contributed to paying off your debt or investments if you did not make those non-essential purchases. You gotta ask yourself, were these purchases really worth it? In order to achieve financial freedom early, you need to limit the amount of cash outflows while increasing your cash inflows. That's pretty simple, right? There's a massive opportunity cost of spending money, especially when you can use that money to pay off your debt or invest. It hurts even more when you're spending money on things that you really don't need. Step 5, increase income. That one's easy. That being said, unless there's some massively wasteful spending habit happening, I don't think the best route for financial freedom is to live a frugal lifestyle. It's a lot harder to cut spending than it is to find ways to increase your cash inflows. I know a lot of articles and videos online will tell you to cut out coffee, cut out eating out, stop going to the movies, and cut out all these other activities to save money. The reality is it's really hard to do. It makes way more sense to focus on how to increase your income rather than stressing over how to save a couple dollars every single day by not getting that cup of coffee or not going to that cool restaurant that you've been wanting to try out. At your main job, your income potential is probably capped to a certain extent, which is why finding alternative income streams is a great way to maximize your income. So how do you do this? One way is to turn your current interests or hobbies into a business. For instance, if you're a software engineer, maybe you could make your own online course or YouTube video series explaining different concepts or techniques that are must-knows before entering the software industry. Find out what people really want to learn. If you really enjoy art, maybe you could try selling some of your own work. If you have a passion that you'd gladly spend time more working on, you can probably make some money with that passion. Another way to do this that is becoming way more popular since the pandemic is to look at what you currently own and think of how you could bring in extra income from those assets. We currently own 2 houses. One is our primary residence and the other is our investment property optimized for Airbnb income. So when we go on vacation, we rent out both homes, which easily covers all the vacation expenses while still leaving us with a hefty profit that we can use on the vacation or save. Usually, our secondary house is always being rented out, so we get some nice income there along with our primary home's income when we want. Another way we bring in extra income is through our cars. We're all working remotely, right? So we do this through an app called Turo, and it's pretty nice. I usually earn about $2,000 per month renting out 2 of our cars because we don't need to use them on any given day. There are plenty of other ways to create passive income from what you own. I've seen people rent out parts of their garage as a storage space, rent out their RV, rent out their bike, surfboard, snowboard, etc. This is a relatively easy way to make some money here and there, so I would definitely look into this side hustle. Overall, it's hard to increase your income solely through your main job, where you trade time for money. That's the reality, huh? So try spending some time and brainstorm some ways you could earn money through your expertise, your passions, or your property. All right, the final step to achieving financial freedom. Invest, invest, invest. One of the best ways to invest and grow your wealth is through the stock market. There are 2 reasons why the stock market is by far the best place to grow your wealth. The first is taxes, actually. Long-term gains do not get taxed as ordinary income like side hustle income does. So if you're buying and holding stocks for the long term, your long-term capital gains tax rate will be 15% or a max 20% at the federal level. But if you have a passive income stream that allows you to pull out cash monthly, you might be paying ordinary income tax rates on that full cash flow, and that can range between 22 to 37% for most people. The second reason is time. There is such a thing as completely passive income, but in most cases, passive income does require some significant investment up front, typically through time. For example, some people will say starting a YouTube channel is passive income, just go do it, because once you make the video, it earns passive ad revenue at some point. Well, that's true, but you still have to write the script, record the video, and edit the video. There's 3 phases of production. That takes a lot of time and consistency. Remember when we talked about compound interest and how it can dangerously grow your debt over time? Well, with stocks, the effects of compound interest are completely positive. That's why they're referred to as compound returns. Over the long term, you can compound your investment returns exponentially and reinvest your earnings just by letting it sit there. Nothing really gets better than that. So you're probably wondering, okay, Tony, this is great, but what do I even invest in? The stock market just seems so complicated and I have no idea where to start. It's a completely normal and expected response, so I get it. We were all there at some point. Investing can certainly be super daunting at first, but whether you're creating your first portfolio or looking for more sophisticated strategies to help maximize returns while minimizing risk and taxes, Wealthfront is here to help. Through our award-winning robo-advisor, we can build a personalized portfolio of diversified, low-cost index funds designed to grow your wealth for the long term. If you want to customize your portfolio, that works too. We offer hundreds of funds in categories like clean energy, tech, crypto, and more. Best of all, it's all automated. We'll automatically help you rebalance your portfolio, diversify new deposits, and we'll even help you save taxes through tax loss harvesting, all at a low cost of 0.25%. To learn more about our automated investing process, check out the links below. That being said, thank you so much for watching, and I hope you now have a better understanding of just how you could achieve financial freedom early. Make sure to like and subscribe, and I'll see you in the next video.